Hey, good morning, everyone, and welcome to another session of Decipher with Dezerv. Today is Saturday, the 17th of Jan 2026. I'm Kushal Karkare from the investment team at Dezerv. I work on portfolio analytics and market insights. And thank you very much for taking the time to join us here on a weekend. Over the last few years, markets have reminded us that investing isn't just about picking the right products. It's about how investors behave and when markets are uncomfortable. Today, we'll decode why behavior plays such a critical role in long term outcomes and how a structured portfolio to investing helps us navigate this uncertainty. Joining us here today is Prateek Bagaria, the principal officer for our PMS business at Deserve. Prateek looks at how portfolios are built, how risk is managed, and how investors stay disciplined through different market phases. With over 20 years of experience in markets and wealth management, he's seen firsthand how investor behavior either compounds wealth or quickly erodes it. Prateek, good morning and welcome.
Good morning, Kushal. Good morning, and welcome to all the viewers.
Before we begin, a quick housekeeping note. Please feel free to drop your questions in the chat at any point during the session. We'll pick them up and address them towards the end. And please also leave your feedback once this session concludes. It really helps us improve our content and deliver more insightful sessions going forward. Pratik, before we get into the frameworks and charts and the whole gist of it, after your over 20 years of experience in the market, what's one behavioral mistake you've seen the investors repeat across cycles?
Many actually, but the primary one would be, say, the loss aversion or panic selling. Most investors think that they do not sell in panic or they are not affected by volatility. During good times, yes, that is true, but during bad times, volatility does affect their behavior.
Got it. With that, let's get started.
So,
Markets today are far more information rich than ever,
yeah.
yet investor outcomes haven't necessarily improved in the same proportion. Why do you think behavior rather than intelligence or access to information ends up being the biggest driver of outcomes?
So let's break down the outcome a little bit, right? So let's say if everybody is at par, has the same knowledge, has the same information, behaves the same way, then everybody would be theoretically generating the same kind of return. But there are people who do better than others. The reason for this, some researchers have found that there are four key edges that some investors have over the others. So the first is the structural edge. Basically, that means what is the size of capital you are investing. Just an example, it could be more. But say, let's say a large investor who has access to uh, 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 good data, etc. Or let's say just because the corpus is large, the brokers gives him a discount on the brokerage, and he enjoys a cheap brokerage or cheap leverage. That is a structural advantage that such a person has. Obviously, the discount in brokerage will result into directly into his bottom line or gains. Second is what is the information edge that you have. So compared to the rest of the market participants in, do you have any extra information? While this sounds great, but it's almost illegal to most of the things are illegal. You should not be in possession of extra information and very
Right.
tightly regulated, right? So this is one information edge is one thing which is to be treaded carefully. You want more information, but you should not be wanting too much information which others do not have. The third part, we can look at this as the ability to process that information or your analytical edge. So while everybody might have the same information, how you analyze and process that, that is another differentiation that is among the market participants. But finally, the behavioral edge, as in how you behave after you have invested, before you have invested. And by behave, I would mean, are you able to weather a storm? As in, if there is a drawdown in the market, are you able to hold on to your conviction, your positions? Are you able to manage your biases? are you holding it too long, too short, um, because of your biases? So those are the behavioral edges that makes the market participants different. While the first three are pretty material and can be obtained externally, right? The behavioral edge is something that is very much intrinsic to each one of us, and that's a problem that nobody can solve for you. You need to do something about it yourself.
Got it. If you were to maybe go about assigning a level of importance to each of these, where would the behavioral edge lie in that?
So at different time, each of this is important, and it contributes in a different way. So structural advantage, as I said, is I gave the example of brokerage that might contribute 2 or 3 paisa, 5 paisa at best to your returns. Uh, Information edge. Sorry, are you able to hear me?
No, I think we lost you for a bit there. Can hear you now. You were telling us about the structural edge and how the others, like what level of importance you would assign to them.
Yeah, so at different point in times, for example, let's say when the going is smooth, the behavioral edge might not be as important. But when the going gets tough, market is in a drawdown, it's a volatile phase, that is when your behavioral edge will become more critical.
Understood. So, in terms of this behavioral edge, are you seeing this play out even amongst the most sophisticated and high income investors?
So humans are the same across geography, time, and uh, I think wealth spectrum, I believe. But so yeah, it affects everybody.
Understood. One of the concepts we often talk about is the bias blind spot. The idea that we recognize biases in others far more easily than in ourselves.
Yeah.
Which behavioral biases do you see showing up most often during volatile markets?
Uh, During volatile markets, we have, before I get in there, first, I would like to say that in order to see any kind of bias that we have, first we need to admit that I can be biased, right? Most of the people think that the other person can be biased, but I am pretty much rational. And that's not right. Even the best of psychologists would have their own biases. And there is no harm accepting that I have my biases and I have to prepare a structure around this to protect myself and my decisions from these biases. Moving on to what biases do we have during a volatile period? I would just like to give you an example of let's say two asset classes or two portfolios, portfolio
Okay.
A and portfolio B. It's on the next slide.
Yeah, just a minute. Yeah.
Yeah. So let's say we have two choices here, right? You have the red portfolio, the portfolio B, and the blue portfolio, the portfolio A. Both of them, on an average, generate 15% return. Uh, but these are the yearly returns plotted on the chart. So, which one would you pick, Kushal?
So, to my mind, just looking at these numbers and the lines there, I would pick portfolio B purely because it looks like a smoother journey.
Yeah, so smoother journey is clearly a preference, isn't it? So you
Yeah.
want to avoid volatility. Generally, we have some aversion towards volatility or losses. That is proved in the prospect theory also by Daniel Kahneman. He's no longer amongst us, but this excellent theory that he gave us that on the upside, right? Let's say if we make a 5 cents gain, uh, the pleasure is not as much. There is obviously you feel good about it, but the pleasure is, let's say in this chart, around 15, 17 units. But if you lose 5 cents, the pain is much more. So it will be negative 40 units. So you almost feel two and a half times the pain for the same amount of money lost. So had it been rational behavior, it should have been a linear thing, right? But we feel the loss is more compared to the gains.
It.
Do you?
Like you've articulated this very well, but most of our modern portfolio theories and theories around portfolio construction run with the assumption that your investor is rational. Now, why does volatility act like such a powerful trigger for poor decision making?
So during volatility, many of the biases get triggered, right? You are following a certain um, strategy, and suddenly strategy starts going astray, and you have to you do not have an answer. And during those times, when you start functioning from your intuition, that is when the biases start kicking in, because now you no longer are working in the framework that you had created for yourself. Situations have taken you out of your comfort zone, and now you are doing an improv where you are acting with your intuition, and that's when obviously intuition. When you are acting with your intuition, biases will kick in.
Got it. So like we saw earlier the two portfolios, one with a smoother journey. If you could maybe put this in context of, let's say, Indian markets and the things that we've seen over the last 10 years, has how has this played out and how would most investors have reacted in situations like that?
Yeah, so the numbers are right in front of us, Kushal. Over the last 10 years, I just took out some examples here. These are the five events where markets have shown sharp correction in a single day. For example, in August 2015, when the yuan was devalued and there was a global market rout, Nifty fell by 6%, almost 6% in a single day. Right? That has to be panic selling. It can't be like value getting eroded in a single day.
Right.
Then you have we had the demonetization announcement on November in November. That again triggered around 6.5% of fall in a single day, followed by COVID. COVID, obviously, all of us were pretty concerned how things will turn out. And once the lockdowns were announced, we had a 13% fall in a single day on the indices. Some recent example would be the general elections that took place in June 24. We had the exit polls for that, and they were not in favor of BJP, and that's when again markets gave up 6% in a single day. And more lately, when the Trump's announced reciprocal tariffs, market again fell by 4.5%. In fact, as late as I think the first or second week of January, 8th of January, we fell by 4.5% on the index. So these kind of volatilities or panic selling, they tell you that during an uncertain time, investor is finding it difficult to hold on to their position, and this panic selling is resulting into those crashes.
So how does an investor navigate this entire thing? Like how do they mentally reframe volatility so it doesn't derail long-term plans? We often hear this phrase buy the dip, but
Hmm.
when the dip comes, we're almost always uncertain as to whether this was a genuine correction or there was something larger at play. So how
Yeah.
does one navigate this when it actually happens?
Yeah. So if you look at the investment landscape, right, you will have multiple asset classes, and all these different asset classes will perform differently at different points in time, right? So yeah, for example, this table that we have in front of us, the 10-year return of mid cap, if you see, is right at the top, 17.9%. But to achieve that 17.9%, the person would have seen 2018, where mid caps were down 13%. Then back to back 2019, where mid caps did nothing, up by a percent. And then in 2020, you see COVID lockdown, right? Very difficult for somebody to weather this entire 3 years of negative to zero returns and still maintain their positions. So while the final 10-year number looks good, it is very difficult that the person would have been able to hold on to their position for such a long time. Um yeah, similarly, you can see for most of the asset classes, if you see any of the asset class, including GSEC, right? GSEC is at the bottom in 2017. You have your US equity, which is at the bottom in 2022. Small caps are bottom quite frequently. Even something like a real estate, which some people swear by, has not been performing for a long time. Uh, and something uh, uh, as basic as T-bill also, right? Like a cash in 2018, T-bill did fairly well. It did better than large caps or US equity, mid cap, small cap. Basically, it outperformed equities. So sometimes even a T-bill would make sense, and sometimes your bet on US equity or say mid cap, small caps might also not make too much sense. So pick any asset class, you will have to counter volatility. You will have to deal with uncertainty, losses, and underperformance, whichever asset class you pick. Uh, it's about creating a framework about how will you protect yourself from this.
Got it. So, I mean, looking at the chart in front of us, the big question, every year a different asset class seems to win. In the 2020, 21, it was small caps, it was gold last year. How is an
Yeah.
average investor supposed to keep up with this constant rotation?
Very difficult to keep up, right? Because as you said, gold did very well in 2025. Most of the return came, the 10-year return is 17%, but most of the return came in 2025. Had you been holding long for 9 years and then just sold it in the 10th year towards the start of it, you would not have realized that 17.2% gain. The returns are lumpy. The way to tackle this is basically, and this is the biggest hack to get your volatility right. And if you get your volatility right, you will have your behavioral edge correct. And the biggest hack is asset allocation. So here in the same chart that we were looking at previously, what we have done is we added these white boxes, right, which is the multi-asset portfolio. Now this is nothing but a combination of three asset classes: 15% gold, 42.5% large cap, and 42.5% GSEC. So debt, equity, and gold, a mixture of these three asset classes. You will see that this is the only way you would have not been in the bottom five of the assets. Like all the asset classes have been in the bottom five, but a combination, if you take off all these three asset classes that I spoke about, then you would have ranged somewhere in the middle. So your final return is 12.3%. And most of the years you'll see you have made returns around that. In fact, the worst year was 2022 when you made 5.4%. Right. So
So,
the
is it fair to say that this sort of a diversification approach is less about improving returns and more about helping investors stay invested?
Yes, it does help improve return also, but primarily it is to help you stay invested, because rest any other asset class you see, right? As we spoke about mid cap, 17.9% is your final return. But during that period, you have seen a volatility of the maximum return being 52% and the worst return being minus 12%. So that is the range. But look at the multi-asset portfolio. Final return 12.3%. What was your max? 5.4%. Sorry, the minimum 5.4% and the maximum was 16.7%. So you tighten the range of your return. So you are very, every year your returns are very close to your expected returns. If you move away very heavily from your expected returns, that is what causes volatility and uneasiness, and then that leads to your behavioral mistakes that one makes.
Got it. So while this multi-asset portfolio that's been demonstrated here, which is constantly like keeping your volatility to a low, it
Yeah,
appears to be a static portfolio, right? Is there a way to
yeah,
introduce when we started the session, we looked at different edges. Is there a way
yeah.
to introduce the structural information and analytical edges which we've introduced the behavioral aspect here. How do you improve the outcome with the other three while maintaining a similar margin of safety?
Yeah, so correctly mentioned, Kushal, that yes, these three are, we took a static portfolio of these three assets. Now, if you are able to, uh, let's say, estimate even slightly with, let's say, 60% accuracy, 55% accuracy, that what the large caps will do, will the small caps be better than the mid caps over the coming time period? Will equities outperform GSEC? While you can't do it uh, with pinpoint accuracy, I'm saying that even if you are able to get this 55 to 60% correct, and it's very difficult to get that 60% also, right? Uh, but if you are able to do that, then the returns or the chart that you see would improve further from here. Because let's say in the right years when you were overweight on mid cap, let's say in this case we have taken 42.5% GSEC, but in 2016, to a limited extent, let's say instead of 42.5, we had taken 50% GSEC. If our view was good, and that was the best asset class that year, then the returns would have been slightly higher for 2016. Similarly, in 2017, if you had reduced GSEC and taken more of large cap, then the returns would have again been a little higher. So, yeah, if you are able to call the asset classes dynamically, which is a very difficult thing to do, and do it within moderation. So, let's say you do a 5%, 10% sort of an overweight, underweight across these asset classes, then with some accuracy, then you can improve your outcome.
Understood. What this also appears to be is, at least to an average viewer, is that you're building a portfolio that is not at the very top, but you're optimizing for volatility. Now, what if there are aggressive investors out there? Is there a way to improve outcomes even for them?
Absolutely. So it works both way, right? It so asset allocation will give you higher returns for the same volatility, or it can give you lower volatility for the same returns. For example, let's say there is somebody who is saying that I don't like volatility. I want to invest only in T-bill, right? In the example that we saw, the chart published by Mint, we saw that the volatility was 0.9% and the return for T-bill investor was 3.8%, right? The first line right there.
Yeah.
But instead of that, if somebody created a portfolio of 3% large cap, 22% credit risk, and 74% T-bill, their volatility, they would have realized a return of 5.2%, which is 1.4% higher than owning only T-bills. And the beautiful thing is that the volatility did not change. It's still at 0.9%. So with the same volatility, you are able to generate a higher return. If we take another example, let's say if you go to GSEC, if somebody is saying that I will invest only in GSEC, the average return there is 7.7%, whereas the volatility is 4.7%. By mixing a little bit of large cap, gold, and international equities, at 4.7% volatility, the same as GSEC, this person can generate 13.1% return instead of 7.7%. Right? So at the
Right.
same level of volatility, the return shoots up. Whereas the reverse is also true. In case, let's take the example of somebody wanting to invest only in small cap because of higher returns. Small cap, the average return for 10 years has been 14.7%, right? For a volatility of 29.4%. If if one can diversify and create this portfolio of S&P, GSEC, gold, large cap, right? They can generate that 14.7% return at just 6.4% volatility, which is less than almost like a fifth of what small cap volatility was.
So just a couple of questions here. One, purely for the benefit of our viewers. We keep talking about risk, volatility. We've quantified it here in terms of numbers, but if you could just quickly give us a workup on what it actually means. So let's look at the asset class which says large cap volatility 6%, return 14.4. Now, when you say 6% volatility, to me as an investor, what does that mean? How do I read these numbers?
So volatility would mean that how much you are deviating from your expected Return. So let's say if your expected return is or your long-term average return is 14-15%, in this case 14.4%, then you can be plus or minus 6% in most of the cases.
Got it. And in terms of all of these different multi-asset portfolios that we've shown,
Yeah.
is do we buy and hold these portfolios or are they rebalanced at some set frequency?
Over here, the portfolios that we've this is a theoretical exercise, right? So the ones which we've done, this is rebalanced annually. But in practicality, you can rebalance it two ways. One, it could be a time-based trigger, that is, every quarter or every 1 year, I will rebalance my portfolio, or it could be a deviation-based trigger. So basically, if your portfolio allocation goes off by 5%, then you will rebalance. Or third could be a tactical rebalance. For example, now if you think that this other asset classes is looking better, you have a strong view over there, then you can initiate a rebalance over there.
Got it. And coming to how we quantify these different ways of generating returns, can you maybe shed some light on what we're seeing here?
Yeah, so in portfolio management, there are just three actions you are taking, right? One is you are deciding that whether I want to invest in debt, equity, gold, etc. Right? That's your asset allocation layer. Then you are saying, okay, that within equity, do I want to buy a Nippon large cap fund, Mire large cap fund, or a stock, or a PMS, whatever? That is your security selection. And then you decide whether I should buy today or should I wait for 1 week or should I stagger. That is basically your market timing. And there are some other uh, uh, effects which lead to returns, but we'll keep that out of today's discussion. Regardless, the first decision that we spoke about, that whether how much you should invest in equity or gold, etc., that asset allocation that defines 92% of your return. What asset classes and in what proportion you've decided to mix that.
Got it. We saw a multi-asset portfolio A, which was shown in the chart created by Mint, and then a few different ones to show how you combat volatility whilst keeping your returns the same. How do
Yeah.
we at Deserve have A offerings and build those portfolios to generate superior outcomes?
So at Deserve, Kushal, we have for equity this PMS strategy called Equity Revival Strategy. Here it will be a mix of it's a multi-cap or a flexi-cap strategy, you can say, agnostic of whichever market cap we move buy mutual funds, which can take different varied exposure in large cap, small cap, mid cap, across various sectors, across various styles of investing. Right, that is one. For debt, we have this strategy called Deserve Dynamic Debt Plus, Triple D Plus. It has exposure to high yielding bonds and some extent of REITs and InvITs also, about 15% of REITs and InvITs also. The high yielding bonds, again, we select them basis of our own methodology, which we call as a PQRS framework. We look at the performance of the person or the company we are lending to, the quality, the rating, and the solvency. These are the three, four parameters that we look at before picking our bonds. Then there is strategic holdings in natural elements, shine. Basically, the base allocation for this strategy is gold. We invest around 50% gold, that is a static allocation at every point in time. The remaining 50 can be in either gold or in silver, depending on the gold to silver ratio. Let's say if the gold to silver ratio, when it went up very high, above 100, we put that 50% into silver. And now, when silver has started rallying and gold not so much, we moved back from silver to gold. So, our base holding is gold. But if silver gives us an opportunity, if it is undervalued relative to gold, we will take a tactical uh, position in silver as well. So, this should be able to generate slight alpha over some alpha over gold
Without
holding.
getting into too much detail, if you could just quickly give us a primer on how it is we're judging that silver is undervalued or overvalued?
Okay. So let's say currently for an ounce, silver is somewhere around $90, and gold for an ounce costs around $4,600. So if you just divide 4,600 by 90, that will give you the ratio of gold to silver. Now, sometimes, let's say if silver instead of 90 becomes $9, right, the
Right.
ratio would just skyrocket and become 10x of what we where we are. So that is when in relative terms to each other, when the price of silver is low and price of gold is high, that's when we shift to silver. Otherwise, the strategic allocation is to be invested in gold.
Got it. Thanks.
And finally, we have this one. The fourth one is Deserve Infra Yield Assets (DIY), or DIA as it turns out to be in Hindi. Here we are taking exposure towards real estate and assets, or infra assets. Um, a company or a REIT leasing out offices, getting rentals, that is one source. Or we could be buying something like a power IndiGrid InvIT, or a power grid InvIT, which basically has power lines, and they lease out these power lines to manufacturers of power, uh, and get rentals. You can have something like a highway InvIT, wherein the tolls collected are the source of income, and on a particular property or on a highway. You could have telecom towers. So any kind of infrastructure, basically it gets capitalized in this form, in the form of InvIT or a real estate investment trust. So the Deserve Infra Yield assets take exposure in these REITs and invest. Across all the four baskets, you have four solid non-correlated assets, which is your equity, debt, gold, silver, and real estate or InvITs and REITs.
So just touching upon the infra yield assets
Yeah,
quickly.
yeah.
In for an investor who traditionally has been exposed to like real estate, right? Physical real estate. What are the advantages or disadvantages something like a REIT or an InvIT would offer over that avenue?
Great question. So, Kushal, it's much more advantageous. One is the ticket size. So if you want to buy a property, there will be a certain minimum, right? You will have to spend a few crores to purchase that property.
Correct.
There will be transaction costs related to that, such as your brokerage, uh, stamp duty, registrations, etc., maintenance. Then there will be the hassle of maintaining it yourself. You will have to physically maybe get in, visit the property, or take care of it. With REITs, none of this is required, right? You can invest as low as, I don't know, 500 rupees, 1000 rupees, and do a SIP, which maybe you cannot do in a real estate. You get a diversified pool as well. With when you purchase a property, you get only one particular property in one geography. But in with REITs, you get a pool of diversified assets across geographies, and sometimes even across styles. As in, there could be REITs which have hospitals, which have hotels, which have offices, as well as residential places. So it gives you a diversification in that sense as well.
Would it also be right to say that you get a near constant visibility on the market valuation for that asset, unlike your traditional real estate?
Yes, so liquidity and real-time value are another two advantages which you will have in REITs. You can sell it anytime over the exchange. You can sell it in part, right? You need not, unlike a property, you can't sell it in part. This one you can do an SWP sort of a thing.
Understood. And finally, like to tie all of this together, we had introduced these four edges.
Yeah.
Can you quickly tell us how we at Deserve and in general an investor should look at all of these to generate a portfolio, not just in terms of superior return outcomes, but also a smoother journey that helps us stay invested?
Yeah. So about behavioral edge, I think we discussed in depth today, and how asset allocation can protect your behavioral edge, right? It can help you sustain that by uh, making your returns closer to your expected returns or average returns, right? And lowering the volatility. In terms of analytical edge or analytical edge, what we have is at Deserve we use modern data analytics models. You have machine learning models, multiple models which can help you analyze and crunch large, vast amount of data easily and reliably. For the information edge, uh, we have access to many secondary databases. We use Bloomberg, CMIE, ACE, Equity, ASMF, um, multiple other data sources that we've subscribed to, but those are secondary. So that is obviously one market data that we get. In addition to that, we also have the primary database. So whatever data we collect from our investors or through other sources, that can also be used at an aggregate level to research about trends, etc. And third, or the fourth one actually, is the structural edge. How the schemes that we spoke about, the way they are structured, every time we try to maximize for quality, as in we get the right instrument and at the minimum cost. And by cost, it could be minimum taxation, minimum expenses, or minimum churn, right? So, for example, if I take ERS, right, in equity revival strategy, you have mutual funds as the underlying. So those are already high quality instruments which are regulated, functioning well. You have great fund managers over there who are able to pick the stocks. You have risk controls in place. The quality part is sorted with mutual funds. Also, mutual funds give you a low leakage structure because let's say things like taxation are very sorted in mutual funds. If I try to run an equity portfolio, I will lose that structural edge because every time I make a churn or I sell or buy a stock, I will have to pay taxation, I will have to pay brokerage. But with mutual funds, one, because of the size, the brokerage amount is much less, and the taxation is also not there for churn. It's only from when you buy the unit till the time, and after you sell the unit, that's when you uh, pay the taxation on the gain. So, so that's for ERS. Similarly, for all the strategies, we try to have that structural edge in place so that we are able to generate market beating returns. So putting all these four things together, Kushal, that's our endeavor to utilize all these four edges and uh, extract whatever can we can to keep investors ahead of the market.
Super, super. Thanks, Pratik. That was great. Before we get into the questions, just touching upon our stance in general.
Hmm.
We spoke a lot about asset allocation.
Yeah.
How would we look at asset allocation today with the current macro backdrop and what we see maybe the road ahead? Let's look at maybe equities. We have a lot of questions on your large, mid, small,
Yeah.
and across asset classes in terms of gold, silver. What sort of allocation limits and barriers should we be looking at?
Okay. So let's answer the first layer first, right? So within debt, equity, and gold, how should we look at things like that? So within uh, 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 these three asset classes, you should have roughly say 10% allocation to gold. You should not be overexposed to gold right now. Bad time to do it because it's already on a tear. It's at a high, and it has been it has basically a crazy year in 2025. Especially silver also, you might want to be cautious when you are investing in that. This is not definitely the time to go all in at once in silver. So there we are a little bit cautious. We would rather prefer gold over silver for the time being. That's the call on gold and the silver. On equities, we would be incrementally getting overweight as the year progresses because most of the headrooms or the head winds that we had for the year of 2025, we were starting with. high interest rates. We were starting with uh, at least some amount of inflation. We were starting with fiscal policy, which was pretty tight. And all of those headwinds have now become tailwinds, right? We have an easy monetary policy, we have an easier fiscal policy, we have had the GST cuts, etc. And also, the inflation has been benign for a good 1 year. Crude oil prices, thankfully, have been not very high. Those have also reduced in 2025. So, all these things should propel the market in 2026. Maybe not immediately in the first month itself, because we might see all these benefits coming in with lag. But as the year progresses, we should see earnings getting better. So equities is something where we would incrementally be getting overweight. And while last year we had given this call of being high in large cap, our ERS portfolio was zero in small cap, and we had some amount of mid cap. That played out really well because last year large caps delivered around 7%, 7.5% positive performance, whereas small caps were negative 2-3%. So that played out well. But this year we want to slowly start reversing as we start increasing our weight in equity. We want to bring down the large cap and again start taking in exposure in mid and small cap, to start with mid cap first and then slowly build a small cap exposure also.
So,
In,
touching on your point of overweight equities and sort of moving towards a risk on mode,
correct.
we have a question on how there's been certain rumblings in the market about the valuation still being inflated. Like if you take away certain segments of the market, there
Hmm.
appears to be a sort of picture that the P's are over 50. Is there something that is different? Like we're looking at it from a different lens. Like what is not right here?
So what can be of concern is growth, right? You do not have consumption growth kicking in. You do not have much of let's say even follow-up infrastructure growth, etc. Where will that come from? The export engine for India, which was the IT, that is struggling with growth, especially of the advent of AI. So there can be questions around growth, but I don't think there should be many questions related to valuations, because we've seen 1 year of flat returns. And as I said, we were coming from a period where we had a lot of headwinds, which have now turned into tailwinds. So as the year progresses, and your earnings start accumulating, you should see the valuations getting only cheaper. The question is whether we will be able to, the companies will be able to follow it up with good growth as well. In a reasonable understanding says that it should, because if your GDP has to grow at 6-7%, which most of the people are projecting, then there has to be growth that has to become obviously coming from corporate India mostly, right? So
Right.
yeah,
So, touching upon Deserve's offerings, you mentioned four different asset classes, ERS being the flagship on equity, triple D plus on debt,
yeah.
Shine on gold and silver, and finally infra yield on the REITs and with side. Now, these appear to be the core allocation to your portfolio. We also have certain other offerings on equity, mainly alpha focus. Could you also touch upon how that piece fits into the larger picture?
Yeah, so again, Kushal, before I get into that, just a small disclaimer or extra note that I want to add to the asset allocation discussion that we had. Now,
Sure.
asset allocation is something that is very personalized, right? It is not a standard thing that is applicable across to, not, there's no one allocation for everyone. It is very, what is your target return, and you want to stay close to that target return everywhere, right? So let's say my target return could be 13%, and I do not want to deviate from it too much. Then I go for an asset allocation that can generate 13% with the least possible volatility. Uh, Somebody could be retired, and 7% with lower volatility would be preferable for them, and they choose accordingly. So while we have these solutions, we have to figure out an asset allocation individually for each of these clients, which the CFPs or your financial partners will be able to do for you. Um, broadly, what I can mention is that for alpha focus, the major difference compared to ERS is that we do not take large cap exposure there deliberately. We have three mid cap funds and two small cap funds. So there also increasingly, I believe one can increase their allocation. And uh, right now we are more tilted towards mid cap, but later during the year it can change in the favor of small cap. But that's a matter of time and how things play out.
Got it. In terms of, again, touching upon asset allocation, not specifically the construct of it, we spoke about how a multi-asset portfolio generates a more stable outcome. What if a portfolio was constructed in a way where you buy and hold it for, let's say, 10, 15 years? How would that outcome vary from one which we rebalance annually?
Uh, s- so there will be two impacts. One is obviously your returns will get it can drag or it can be better, right? The asset allocate. So let's say if the trend continues for 10, 15 years, then for example, your gold got right now somebody had 10% gold, it rose 70%, equity didn't do much. So let's say 10% allocation becomes 17%. If you do not rebalance it and let it go, if the asset class corrects, then you will lose out. But if the asset class stays in trend for let's say 10, 15 years, which is theoretically not possible, then uh, uh, or rather practically not possible. But so then obviously you will have a better outcome in terms of returns. If the asset class corrects, then you are better off doing the rebalancing, because when will you rebalance? Because the asset classes run higher compared to its long-term average, right? That's the time when you sell. So actually, in most cases, it helps you increase your return, the rebalancing. And second, it cuts down your volatility, because let's say if one asset class is you just let it go, stay passive static on that, it grows, and then it that asset class starts defining the volatility in your portfolio.
Understood. So there we have a question on the PMS structure in general.
Yeah.
So one of the many questions that we're getting is if an investor were invested in one of our strategies, let's say ERS, how would they go about building a multi-asset portfolio under the PMS structure without putting up additional capital? Let's say they've invested 50 lakhs to begin with.
So the discretionary portfolios, Kushal, that we have, the 50 lakhs limit is across the strategies. It's let's say if you are investing 25 lakhs in ERS, you can invest 25 lakhs in triple D plus. So all the strategies put together, you need to have 50 lakhs. So you can pretty much diversify your 50 lakhs across these three, four strategies and follow your asset allocation.
Got it. Got it. And in terms of our ERS per se, we are of the opinion that mutual funds offer a structural tax advantage.
Absolutely.
And,
Yes.
and there appears to be a common misconception out there that we churn frequently in ERS. If you could maybe touch upon that and how we are making that portfolio, let's say, to be placed superior to a direct equity one.
Uh, in terms of returns, if you say superiority, you will already see that if you in the AppMe website, you can check. We are doing better than most of the equity only PMSs, right? So even with mutual funds in our PMS, we have outpaced uh, some of the large and some of the very well regarded funds on the returns bit. Second thing was on the myth that generally equity, the mutual fund is more tax efficient. Is it that was the question?
Yes.
Yeah, so that is more tax efficient because in terms of PMS, etc., you pay taxation every time you book a gain or you sell a stock. But in case of mutual funds, you are uh, uh, it doesn't matter what stocks mutual fund is buying or selling. Your taxation depends on the time till you hold your mutual funds. And our churn is not does not exceed 25%. We have some limits. We do not churn our portfolio too much. Generally, uh, 25%, as I said, is the churn limit that we follow. Mm, that means if we have a portfolio of 5 to 6 funds, one fund would ideally stay for around 3 to 4 years. Churn limit, however, the 25% limit is an average. On an average, we would churn 25% over a year. So, uh, theoretically, let's say if I have not churned anything in 3 years, on the fourth year, I might churn the entire portfolio, the 100%. So, in a year, it might look high, but if you look at the long term average, it will not be more than 25%. We try to ensure that your tax outgo is reasonable.
Got it. So we have a few questions around this. I'll try to condense it into one coherent question. Let's say there's an investor who has an existing portfolio of maybe 20 to 30 mutual funds. How do we at Deserve go about restructuring that portfolio once it comes under our purview?
Uh, So after a lot of research, we decide that that basket of 5 to 6 funds is what should be held by mutual fund investors, right?
Right.
So a few things that okay, so you want to move towards those 5 6 funds that we believe will outperform. One is that philosophy. Second is that you want to trim the tail. So basically, anything which has a very small allocation, 5% allocation, 2% allocation, you want to trim those things. You want to exit those things. Second, something which is out of exit load and making a loss, you would want to book a loss there and harvest your tax losses so that you can use that for booking against a gain somewhere else. So these are the 4 5 things that we look at while consolidating a portfolio that has been transferred us to in terms of stocks.
Got it. So, Pratik, final couple of questions. They're
Sure.
surrounding the hot topic of the last, let's say, 12 to 13 months, gold and silver.
Yeah.
So, two-part question. For a new investor, is it advisable to build exposure to Shine strategy at this current juncture? And secondly, this is more around the behavioral bias of it. How is it that we chose to sell silver even when we're seeing it constantly moving up? How do we address that?
Okay, first one first. Uh, Sorry, if you
Yeah,
can repeat the
is
first
it
one.
advisable to build
Yeah.
exposure to Shine even at this juncture?
So Shine should have a strategic allocation of 10%. By that I mean you should have uh, that as a long-term allocation. You need not, it's not a market timing call, but it's that allocation does more than generate returns, right? It provides you hedge against your equity bets. It provides you hedge against a depreciating rupee. So for those reasons, you should have some allocation, in our opinion, up to 10% for in Shine. Second is selling silver. So silver is a very highly, volatile asset class, right? The last time it went up to I think $60 odd. It
Right.
never reclaimed that high for almost 14 or 15 years, right? We won't don't want to be stuck in that kind of a situation. For us, silver is only a tactical trade which can help us generate 2 3% over gold returns. We don't want to chase silver returns, um, and that we have been able to do successfully. We got in to silver at a reasonable price and got out when the price was about 2 lakhs, which I um, believe was a reasonable gain, and that gain adds to our gains in gold. So happy uh, avoiding that volatility. Let's say in case silver prices do crash from here, that would make us more averse comparing to riding the wave till the last rupee is extracted.
Got it. Got it. Super. Thanks a lot, Pratik. This was very insightful. And thanks again for lending
Thanks,
us your
Kushal.
time on a Saturday. Folks, I hope you found this session insightful and enjoyable. Once again, I request you to leave your feedback post the conclusion of this. And we hope to host you soon again next week. Thank you very much.